Good afternoon, traders and investors. Will back here with another one, coming to you with a Friday market recap. Hope all of you had a good day of trading and a beautiful week of trading as well. And in today's markets, guys, well, the bulls continue their rally beyond the all-time highs. The S&P 500 hitting a brand new all-time high today, and the QQQ really not far behind, now itself only just about 2% off of the all-time highs as well. Now, very nice broad market performance today, guys. No sector was left behind in the action today, and that was largely due to two key factors, which number one is the producer inflation report that came in early this morning, and number two, bank earnings that started today and were very well received by the market. Most of your major banks posting decent gains on the day. So in today's video, guys, we are going to cover a couple of things together, of course. Number one, we'll be going over that producer inflation report very briefly, just take a look at the numbers and see how the market reacted. Number two, I have two earnings reports prepared for you guys today. Those are going to be JP Morgan Chase and Wells Fargo Group. BlackRock will probably do on the Monday session. I'm going to try to keep this video as short as possible. After we cover those earnings, guys, we are going to get into our major technical analysis rundown of our major market indexes on the left, on the right-hand side here, followed by our major big tech rundown as well. See if there's still some good deals to be had in big tech. And then, of course, we are going to look at my portfolio, see the closing trades made for the week, how much gains we made for the week, and also take a look at which positions I have left open into the next week of trading as well. And in the Tesla section of the video, guys, later on in the video, we're going to be doing a quick little recap of the Tesla Robotaxi event and giving you guys my impressions on the matter and how it may impact the stock price in the short and long-term perspectives. So a lot to cover in today's video, guys. Let's jump right into the action. SPY up a very healthy 0.6%. The QQQs, however, trailing a little bit behind 0.16%, and that was due to a lot of the damage done today, unfortunately by a few of your big tech names being left behind, right? As you can see right here, Microsoft, not the best showing today, Apple in the red, Tesla pulling back 9% after the Robotaxi event. And on the semiconductor side, NVIDIA not doing too much at all. The other huge name in semiconductors, AVGO. So all of that red contributing to bringing, well, for not allowing the QQQ to run as much as the rest of the market potentially, but the rest of the market very healthy. Banks, highlight of the day for sure. They really went on an absolute tear after their earnings. Healthcare sector coming in with a little bit of a rebound as well. And the bottom half of the market too, guys. Very beautiful performance from industrials, real estate, utilities, energy, basic materials, really nothing being left behind today, looking quite good as a whole. On the one-day relative, guys, you'll see that even better. Nothing getting left behind at all, led to the upside by financials and industrials. And on the 1 week, we still remain slightly mixed. Half and half to be precise. Your major winners, technology, industrials, healthcare, and financials. And to the downside, utilities, communication services, and consumer cyclical. So very mixed market on the 1 week relative performance. But overall, guys, it was a fairly good week for the indexes. So before we get into more technicals, guys, let's go over that PPI report and we'll just look at the numbers real quick, guys. In terms of your producer inflation numbers, they came in, well, a little bit mixed, kind of like our CPI came in yesterday, right? So in terms of the year over year number, well, let's start with the month over month. Month over month was amazing. 0% inflation month over month. The expectation was for 0.1%. So coming in at 0 is a very healthy number. Year over year increase, talking about 1.8%. The estimate was for 1.6. So we did come in a little bit higher than the estimate, but is still lower than the prior month. And that's what's important here. The same thing happened for CPI, right? 2.4 versus the 2.3 estimate, but still lower than the prior month. So the downtrend in inflation does continue. And here we have our core. This was the one little sticky element right here, 2.8. The expectation was 2.7, coming in slightly higher than the prior month at 2.6. The exact same thing happened for CPI, guys. Core, the only element that remained above the estimates. All in all, it was a very healthy report. And if you want to take a look where we stand, here is your producer price index as a whole. You can see we are now back to normalized territory, right? About 1.8% right now on an annualized basis, which is largely the same as prior to the pandemic and similar throughout the same period pretty much of 2013-ish all the way through 2019. So we're really normalized back to what the market is expecting. So overall, I am very happy with this report. It shows that inflation is coming down, both on the consumer side yesterday and on the producer side as well. So unless we get more very negative inflation reports in the future, suffice to say that the problem is no longer with inflation, but now more of a concern, as the Federal Reserve has said as well, is the jobs market and the economic output, right? That is the focus of our concern right now, not so much inflation anymore. Now that that's out of the way, guys, let's jump into our company earnings. And we're going to start it off with a very big one, guys, and that's going to be JP Morgan. So JP Morgan coming in today, 4.44%. They absolutely crushed their earnings. Take a look at this. 9.52% beat on EPS, fantastic bottom line beat, and a very healthy 4.5% beat on revenues. So let's take a look at exactly what JP Morgan was saying and go through a bit of the concerns that some people might have in the light of a possible looming recession, right? A lot of people have been comparing current times to 2007, 2008, guys. It is nowhere even close. 2008, we were dealing with a global financial crisis because the banks were over leveraged in derivative securities, mortgage-backed securities to be exact, right? If you want a quick summary, back then, 2005, 2006, if you were making $60,000 a year, the bank would literally approve you not only for 2 cars, 1 house, a cottage, a condo in Florida, they would approve you for absolutely everything. And obviously, when the economy went into a recession, well, everybody got liquidated and the banks were underwater severely. But since then, there have been restrictions put on banks as to who and how much they can lend out, of course. Not the same thing at all. And by these earnings reports, you will see, guys, the banks are extremely well capitalized. So if we do come into a recession, guys, it's not going to be 2007, 2008. It's not going to come from the banking sector as a whole, right? Which bleeds into consumers. It's going to be the opposite. It's going to be consumer discretionary spending pulled back and gradual loss of employment as companies pull back on hiring and start to protect some of their profits even more. Every single recession is different, but to compare this possible one coming up to 2007, 2008 is really apples to oranges. So let's get into JP Morgan real quick. JP Morgan shares pop 5% after topping estimates on better than expected interest income. And we're going to focus on net interest income here, guys. The one main thing that you need to understand why it's so such a widely used metric for banks, it's because that's how they make most of their money. Everybody knows that the banks makes most of their money on loans that they give, right? But the interest rate doesn't really matter for a bank, right? And I'll explain why. The banks always make the same spread. So let's say interest rates right now are 5% at the Fed. What the bank will do is they're going to borrow at the Fed for 5% and then lend to you for 6.5%, and they will pocket the 1%, 1.5% spread on that difference, right? Very simple. But when rates come down, let's say to 2% at the Fed, the bank's going to do the same thing. They're going to borrow at 2% and then lend to you at 3 or 3.5%, and they will pocket the exact same spread. What's the difference between high and low interest rates is the demand for loans, right? So when interest rates are really high, the banks don't have an extremely high demand from consumers, businesses, private equity. They don't have a tremendous amount of loan demand. So they're issuing less and less loans. That's why even though interest rates are higher, they're not going to make as much money, right? And then when interest rates are really low, everybody wants a mortgage, everybody wants a car loan, everybody wants to finance appliances. Any big ticket item you can possibly think of, people want to finance it. So that drives up demands for loans. And even though the bank's making the same spread, the same difference on each loan it issues from the amount it borrows versus the amount it lends out to you, well, it has more volume, right? So hopefully that makes sense in terms of supply and demand for loans and how it impacts a bank's net interest income, right? So let's move on further. Let's move into the article. Now, JP Morgan posted third quarter results that topped estimates for profit and revenue as the company generated more interest income than expected. So JP Morgan said profit fell 2% from a year earlier, while revenue climbed 6%. A little bit of an offset right there. Net interest income rose 3%, exceeding the street estimates on gains from investments in securities and loan growth in its credit card business. CEO Jamie Dimon touted the firm's quarterly results in a statement while also addressing regulators' sweeping efforts to force banks to hold more capital and expressing concern about rising geopolitical risks, saying the conditions are treacherous and getting worse. He's actually slightly in favor of the more strict requirements for bank lending to avoid a situation like 2007 and 2008 where everybody gets over leveraged, and then when things hit the fan, well, you have a bunch of these banks going underwater. We do not want a repeat of that, but so far, guys, it's not looking like that at all. Here's what Jamie Dimon said. We believe rules can be written that promote a strong financial system without causing undue consequences for the economy. Now is an excellent time to step back and review the extensive set of existing rules, which are put in place for a good reason, to understand their impact on economic growth and the health of markets. The bank's results were also helped by its Wall Street division. Investment banking fees climbed 31%. Equities trading jumped 27% as well. The company also raised its full year 2024 guidance for net interest income from the previous quarter, saying that NII would roughly hit $92.5 billion this year, up from the previous $91 billion in guidance. Very good net interest coming up, guys. And that's what we're going to see more and more of the banks saying over the course of this quarter. As interest rates are projected to come down, net interest income for the banks has been going like this through the rate hiking cycle. And now we're approaching the trough. We're approaching that point of inflection where now it's actually going to start moving up higher. Now, the banks are still a bit timid in terms of their net interest income guidance for the next 1 to 2 quarters as we continue pricing in more and more interest rate cuts. But after that, right, it's a very long cycle, the rate cutting cycle, right? Thereafter, we should be bottoming out and it should be moving to the upside. So it's good for banks over the medium to long term. Now, JP Morgan's provision for credit losses. Listen to this, because this is all about the consumer. Is the consumer over leveraged? Are they overburdened with credit card debt and loans? Take a look at this. JP Morgan's provision for credit losses in the quarter was $3.1 billion, worse than the previous $2.9 billion estimate, as the company had $2.1 billion in charge-offs and built reserves for future losses by $1 billion. Here's what they had to say. Consumers are fine and on strong footing, and the increase in reserves was because the bank is growing its book of credit card loans, not because the consumer is weakening. This is by the CFO himself, the Chief Financial Officer. Now, here's what they had to say more further. In terms of the CFO, he reiterated the bank's view that net interest income was headed lower before rebounding in the future. So looking very good across the whole, guys. Sorry, I had to mute there. There's some fire trucks passing by. As I said, I live downtown, so you'll hear a number of those things sometimes. So moving on further, guys, into JP Morgan's actual report. And the only thing I want to show you guys is essentially what we're going to be looking at here is going to be their fortress balance sheet. Is the bank well capitalized in the event that we go into a recession and people panic and people withdraw their money from the banks like they did in 2007, 2008? Well, all you need to do is look at the CET1 ratio. This essentially is a standardized rate that the Securities and Exchange Commission, as well as the Federal Reserve, has mandated the banks to stay above. The minimum requirement is about 11%. This just means that it's the capital requirement ratio, the minimum amount of cash that the bank needs to have ready at any given time in the event there is a flight of capital from the bank. And here you can see they have about 15.3% in ready to sell assets that they can use if ever there's a risk of deposit flight. So they're well above the minimum threshold here of 11%. So that is a very, very, very healthy ratio right there. The other ratio we look for is what you call the liquidity ratio right here, which is known as the LCR. You need to have this above 100%. This is the deposit flight risk in the first 30 days. So essentially what it means, guys, is the bank needs to be able to have enough cash for it's similar metrics, but a little bit different in terms of liquidity metrics, right? In terms of how much cash the bank needs to have on hand, either in cash or readily sellable securities, marketable securities, to cover up 30-day deposit flight from consumers. And as you can see, we are well capitalized here above the 100% minimum requirement. So looking very good, guys. On both of these ratios, they are well above the minimums. And that's all I wanted to say. The banks are very, very well capitalized. So moving into JP Morgan's valuation real quick, guys. Well, this one, obviously, we know is at the all-time highs. And it's fairly rich right now. The 2024 forward P at $222 is about a 12.52. The historical average for JP Morgan over the last 10 years is about an 11.61. So the bank right now, I would not say that they are in a tremendous value position. As a matter of fact, if you take a look at the analyst estimates right here, the analyst targets are literally right around the current share price. It's not the best deal, even though they will be doing a good job with EPS. Not really expanding too much, even revenue, right? Revenue kind of tapering off here for the next 3 years. So JP Morgan not going to grow as much as you would like to see, which is why for me right now, I'm not really touching this stock at all, guys. It's great if you have it. If you have it, it's a hold, but I would not be initiating a position up here on JP Morgan. That's just my take on the matter. I would be more interested in this one if we fall under the $200 mark. If ever we challenge the 190s back to 180s, I could get interested in this one again. But for now, for me, the valuation right now, it doesn't leave a lot of wiggle room in terms of having good risk to reward to the upside, even though they have an extremely strong balance sheet, very solid profit margins in terms of net margins and everything like that. Just not a good buy for me. So that's everything for JP Morgan. I love the company, but I just don't like the share price right now. So for me, this one is a hold. It's not a buy. It's not a sell. It's just a hold. Moving on to company number 2, we're going to be covering Wells Fargo. So I'm going to do these bank earnings relatively quickly. So Wells Fargo Corporation right here, I'll remind you in terms of what they have. Today, up 5.61%. Another good showing by this bank too. Look at the profit margins, guys. Bottom line beat on EPS here by about 11%. We did have a very nice revenue, well, not very nice, but very slight revenue miss here by about 0.18%. Not the worst for Wells Fargo as a whole, but this bank too doesn't really have a problem with positive net margins. Their net margins are actually very good. The bank is also well capitalized. So let's look at a bit of their article. Wells Fargo shares jump after earnings top Wall Street expectations. So let's get into it. So the better than expected earnings came even with a sizable decline in net interest income. Funny enough, but they too said troughing out right now and going to recover into the midpoint of next year. The San Francisco-based lender posted $11.69 billion in net interest income, 11% decrease from the same quarter last year, and less than the $11.9 billion estimate. Wells Fargo said the decline was due to higher funding costs amid customer migration to higher yielding deposit products. And that will soon subside because we know money market funds, guys, the rates are going to get lower and lower and lower and lower, right? So our revenue sources are more diverse, and fee-based revenue grew 16% during the first 9 months of the year, largely offsetting net interest income headwinds. So all the divisions of these banks are doing great, guys. The equities division, the wealth management division, the investment banking divisions, all of them are doing very well, and JP Morgan said the same. The bank set aside $1.07 billion as a provision for credit losses, compared with $1.2 billion last year. So the bank is setting aside less for credit losses. We saw that from JP Morgan too, right? JP Morgan said that they were doing more for credit provision losses, but it's not because consumers are weak. It's because their portfolio of outstanding loans increased. So obviously they have to increase the amount of provisions in proportion, right? Wells Fargo, contrarily, right? They have now reduced the amount of credit losses that they're setting aside money for in the event of customer defaults. Wells repurchased $3.5 billion in common stock in the third quarter, bringing its 9-month total to more than $15 billion. That's crazy, guys. $15 billion, 60% increase from a year ago, right? $15 billion, you just have to look at their market cap, right? Their market cap is roughly 207. So 15 divided by 207, they literally bought back this past year 7% of their entire market cap, guys. That is absolutely ridiculous in my humble opinion. So let's move on further, guys. Now, what I want to show you guys is the transcript from the earnings call in terms of the health of the consumer, because the article didn't cover it. The office market remains weak, and we expect to continue additional charge-offs in our commercial real estate office portfolio, and have accordingly maintained strong allowance coverage. So they know that the whole commercial side of real estate right now is struggling, so they set aside the proper coverage. Overall, here it is. Customers in our consumer businesses continue to hold up relatively well, benefiting from a strong labor market and wage growth. Consumer charge-offs declined from the second quarter, driven by lower losses in our credit card portfolio, while our other consumer portfolios continue to perform well, reflecting the benefit of prior credit tightening actions by the bank. We continue to look for changes in consumer health, but we have not seen meaningful changes in trends when looking at delinquency statistics across our consumer credit portfolios. These are two of the biggest banks in the United States, guys, and they are not saying that there's any signs of major red flags just yet in the consumer, right? So we have to take everything we've been seeing. You guys, well, not all of you guys, right? But a couple people have been saying the jobs numbers are fake, the GDP numbers are fake. Well, now we get to hear from all of these different consumer-facing companies, right? We got to hear from Pepsi and Domino's Pizza this week, and they acknowledged that even though the macroeconomic environment was tough, that consumers were still somewhat well-positioned, right? that their demand was not absolutely falling off a cliff, but that they're noticing that trend of consumer discretionary spending go down. Well, now we have two of the largest banks in the entire United States saying that per their client base, which is a massive client base, other than the lowest income segment of those customer bases, we do not have any major red flags, nor in customer delinquencies for credit cards, nor in defaulting on their loans. And in the event that they do, the banks are extremely well capitalized to prevent major losses. So this doesn't sound very recessionary, does it, right? Now, we have certain red flags still right now, but we do not have fall off a cliff recessionary flags, which is what I'm looking out for, right? I try to stay as objective as possible, guys, which is why we look over the economic data and we look over these earnings reports as well, right? So that's just the fact of the matter right now. Wells Fargo not looking too bad. So if we take a look here as well, in terms of their losses for credit provisions, you can see right here, the regulatory minimum for them is 9.8% for their CET1 ratio right there. You can see that they are above the expectations here at 11.3%. So well capitalized are these banks for their that ratio right there. Now, if you take a look a little bit lower, you will see that, did I lose it already? Oh, it was above, right? So credit quality, allowance for credit losses for loans. Do we see, now this is the last 5 quarters, do we see this number ballooning to the upside, or are they actually reducing it? As you can see, they are reducing this number, right? And this is just not a bunch of people at a table, guys, that are just figuring out whether or not they should reduce this or not. This is done by their proprietary algorithms. They analyze a ton of consumer data across the banks, and the algorithm tells them what the optimal ratio of capital requirements are in relation to what they want to have as a baseline minimum. And as you can see right here, guys, right, the allowance for credit losses, guys, even though the percentage is a little bit higher, they're decreasing the total amounts, right? So as the portfolio of loan grows higher, they're still reducing the proportion of the amounts that they leave for any bad debt whatsoever. So once again, this bank too, extremely well capitalized. So I think you guys are getting the gist of things, right? The banks are extremely well capitalized, and I do not see any major big risks to these financial institutions, even if we would go into a slight little bit of a soft landing recession right now. Wells Fargo, same thing for me, guys. The PE ratio, I'm not going to do all the analysis right now. All you need to know is the PE ratio on a forward basis is a little bit high, same as JP Morgan. They are very close to their all-time highs. It's not the best deal right now out there. For me, this one also remains a hold. You can see the analyst price targets are very close to the current share price. We do have expanding EPS. We do have expanding revenue, but it's a little bit choppy over the next couple of years, as you can see. So for me, this one remains a hold. I would be more interested in playing it, and I did play it a lot, if we somehow dip back down into the mid $50 range. I like the valuation a lot better down there. But if you're holding these shares, I don't see any reason to sell. Not financial advice, just my opinion on the matter, right? So that's pretty much everything for our banks. I know we went through those quickly, guys, but we went through the most important parts, right? Is the consumer healthy, and are the banks well capitalized? And for the most part, we got our answer to those 2 questions. I will follow up on Tuesday when we get more reports from Bank of America, Goldman Sachs, and a bunch of other people too, Charles Schwab as well. Now, moving into the technical part of the video, guys, we're going to go through these quickly because not much has changed. We know who's in control. We've been talking about this one all week, right? So daily uptrend confirmed by the bulls, still marching higher because we still control the hourly uptrend. If you want to see when this move higher is going to stop, just watch for a loss of the hourly trend and also a loss of the 12 EMA, which is your short-term guide. But as of now, the bulls are in full control, guys. Any move lower, just looking for a daily higher low for possible further trend continuation, looking very good. Tons of space. Anything above 566, daily higher low for further trend continuation. And in the event we roll over, daily downtrend, you guys know the drill. Just looking for a weekly higher low for possible further trend continuation. The bulls with tons of space on this weekly, guys. Anything above 540 for the weekly higher low. Here's your area of confluence, guys, with the weekly 12 EMA. It is going to be your green box, 564 down to about 558 for the next support level, possibly weekly higher low, and maybe due for a little bit more of a run in November. So we'll have a look. At the QQQs right now, 0.16% to the upside, looking good, daily uptrend once again, but still no new highs. The QQQ is getting a little bit stopped out, right? So I wouldn't say that this new leg of daily uptrend continuation is in full breakout mode just yet. That being said, the bulls are looking very, very healthy, guys. Tons of space, even if we top out here and break down a little bit lower, anything pretty much above 478. Looking for the daily higher low for further trend continuation, looking very good. Why do we have a bullish leaning bias? Because the bulls are now in a beautiful weekly confirmed uptrend as a whole. So even if we lose this, guys, daily downtrend, is it that big of a deal? Who's in control here? The bulls are in massive control, just looking for a weekly higher low, anything above 447, weekly higher low for possible further trend continuation. The QQQ will be heavily impacted by a bunch of earnings, guys, and next week is going to be a crazy week for earnings. It is going to start off with a lot of huge companies, ASML, TSMC, Netflix. So those are going to be your biggest movers in terms of your QQQ ETF as a whole, right? But as of right now, the bull's looking good. Financials obviously blasting off beyond the all-time highs, 1.93%. All the banks performing excessively well, guys. Take a look at everything here, right? Everything financials, Affirm, Wells Fargo, Bank of America, 5%, right? JP Morgan, 4.5%. Even SoFi coming up, 4.4%. Robinhood exposed to financials as well. So many names in financials were up huge today. So normal that the entire financial sector was doing very, very well. That being said, daily uptrend is now fully in motion by the bulls. So in the event, we have a little bit of a top out factor right here. Just be mindful though, guys. Look at this daily MACD. We've been consolidating now for about a past month. And now the daily MACD is crossing. So further follow through is anticipated. Even if we were to backtest this as support, the likely result would most likely be for a little bit of trend continuation. The bulls have all the momentum back in their camp, right? So looking very good, guys. Any pullback at this point, looking for a daily higher low for further trend continuation, anything above 44.91. And you guys know one of my favorite trades coming up shortly, breakout, retest, and run. So I'll be possibly looking for an entry on that trade right there. Weekly looking amazing. We had a bullish leaning bias. I was telling you guys about this the last couple of weeks. Beautiful weekly uptrend, consolidation. This is a bull flag, guys. Classic bull flag. It even looks like a flag, right? Extremely nice bull flag in motion. And now we got the follow through. So beautiful weekly trend confirmation once again, looking to move a little bit higher. The bull's in full control of every single time frame on your financial sector right now. Moving into healthcare with a good showing today, 0.73%. And this one is trying to reverse the daily downtrend. So we know big daily downtrend, the most recent leg of selling is now being almost entirely engulfed by the bulls. This is the best case scenario. Look at the size of the retracement, guys. 90+% retracement size, so looking very good. Two ways of getting out of this downtrending motion. Either you're going to put in a 100%, over 100% engulfer and reset the daily uptrend above here like that, or in the event we top out right here because it's now resistance, right? I'm not going to lie. This is a very prominent area of resistance. You've seen what it's done in the past. It's been support, then acted as resistance. So I would not be surprised if this is still resistance. If we top out here, the bulls have tons of space to reset into a daily higher low for a daily uptrend shift. So looking quite good for there. And as well, look at the daily MACD, guys. Same thing as financials. We've been sideways and down for the last month and a half at this point, looking quite good for the recapture and daily trend expansion. And why do we have a bullish lean, guys? Well, the weekly was a weekly downtrend. We were looking for confluence with our support level. We got it. But over and above that, guys, weekly downtrend, what are you looking for, right? Especially when you know we've been very bullish. We get the weekly downtrend, zoom out. What are you looking for? Monthly higher lows for further trend continuation. So I would not be surprised if this is the start of the possible next leg up of rally for healthcare. So a lot of names in healthcare, guys, coming up next week. One of the biggest ones, of course, will be not that United, this United right here, United Health Group. So we'll be on the lookout for some healthcare plays over the course of next week. Moving on to SMH. SMH up a beautiful 8.8%, guys, and breaking the high. So finally, daily uptrend, new leg of daily uptrend confirmed. The bulls are looking very good. Not quite yet beyond our level of resistance, though almost there, 258. One little more push will probably do it. And that would open up maybe the breakout, retest of this resistance, which will now be support, and run. Love that style of trade setup. And if we fail from here, guys, there's tons of space. Anything above 238, just looking for a daily higher low for possible further second attempt at smashing that resistance. The bulls are looking very good. Beautiful weekly uptrend chart as well. So even if we lose this, guys, even if we lose this daily downtrend, you guys should be knowing what's coming up next, right? What are we looking for? The weekly higher lows for possible further trend continuation. Down here, big support. So if we pull back here hard, I'll be looking to sell some puts on my favorite semiconductor names right there. 238 down to about 226. And this one will be heavily impacted by ASML earnings next week and TSMC as well. Two of your biggest components of that index as a whole. So moving now on to the Russell. The Russell having a very good showing today, guys. 2.03% to the upside, really going on a tear after being muted. And the Russell is not looking too bad, right? It has its struggles. We know that the risk on trade is not yet fully active, right? It has some days where it goes, some days and some weeks where it goes crazy. And then when we get bad economic headlines, we know that all that craziness gets subdued in a very quick manner, right? So we will keep our eyes posted on this one, but the bulls, big engulfing move at this point, guys. So they're looking for the daily uptrend recapture. We will see if they can get it. The weekly too is not looking bad. I'll give them that, right? Tightening range. This looks like a bull flag, guys. It's a tightening range with a bullish leaning bias because we're consolidating now at the top end of the range, right? So it really looks like it wants to break out here. So in the event we get a breakout of 225, that would be your first weekly confirmed uptrend, guys, in quite some time, right? Since this one back here, since we fell off in early July or late July rather. So it's been about 2.5 months for the Russell. Next area of resistance, I will keep you updated, is about 235, 230 to 235, next target area of resistance for the Russell. So congratulations to all the small cap bulls. Very nice day, but I wouldn't be surprised, guys, if this one still remains a bit of a challenging trade in the foreseeable future. Now moving into the Dow Jones. Lastly, Dow Jones up about 0.97%, brand new all-time high for them as well. No secret there, guys. We had a bullish leaning bias. Beautiful daily uptrend, sideways consolidation, and now the new daily uptrend is reset. Why were we very confident in this trend's ability to break to the upside again? Well, who is in control of the longer time frames, guys? Weekly uptrend was never an issue. The monthly uptrend was never an issue as well. Bulls had full control of this, so you should not be surprised that we have a bullish break to the upside. That being said, any move lower at this point, you guys know the drill, looking for a daily higher low for possible further trend continuation. And now once again, we get one of my favorite trades, right? Break out of the resistance, breakout, possible retest and run. That could be a favored trade setup if you're looking for some futures entries right there. So the Dow Jones bulls looking extremely good. No red flags at all. Now, moving into some of our other sectors, right? So yields, got to take a look at yields again. Another day of upside, guys, and this is getting really overdone in my opinion. Daily overbought conditions coming up into our big resistance area that we had back here in June and July. I would not be surprised if yields are really topping out soon, guys. In my opinion, this is just pure speculation by bond traders right now. Essentially, what this is saying is that the Federal Reserve is going to embark on a slower than anticipated rate cut cycle. I do not think that's the case. Maybe some worries about inflation baked into this trend as well, but I would not be surprised, guys. I mean, we are in a monthly confirmed downtrend at this point, looking for the monthly higher lows for a continuation of the downtrend on the long-term yields, right? 10-year yields as well, coming up very high, but 4.5% for the 20-year, guys. That's very high right now, and it's reflected in the TLT as well, right? This trade coming to a bottom. Bonds are really getting oversold right now. It's been a tremendous last 2-3 weeks of destruction in the bond market. I do not think it's warranted, but then at the same time, we are in a monthly uptrend, looking for a monthly higher low for the eventual monthly trend continuation higher, guys. I would not be surprised if this is probably going to be a, short-term bottoming out zone now, whether or not we completely engulf this like this and reset, or we just hover around the bottom here for a little whiles before doing it. That is anybody's guess, of course, but we're really coming up into crush territory on the bonds right now. 4.5%. Effectively, the rate cuts have had the absolute opposite impact on your long-term yields. Here's your rate cut day right there by the Federal Reserve, and we've literally come up, the exact same amount that the Fed cut. So this, in my opinion, is just pure speculation by bond traders at this point. It's become way too overextended. So that's just the fact of the matter, or just my opinion on it, rather. So we'll be monitoring this one very closely coming up, but I think this one should be topping out soon in terms of your yields. Taking a look at gold right now, gold rallying substantially right from the lows, and we know that gold's been in a beautiful weekly uptrend right now. So any pullbacks do still remain for buying, guys. daily downtrend was underway, and now same thing is going to happen, right? Size of the bounce, fairly decent. So you're looking for either the fully engulfing move and the back test and run for a trade entry, or just simply the retest right down here and possibly run for the new daily uptrend. I'm not in any gold positions right now, guys. I'm waiting for a little bit of a more of a pullback to the weekly 12 EMA. If we don't get it, no problem at all. I have tons of other trades, but as of right now, gold is still looking extremely strong. Monthly full control, weekly full control as well. Just a little bit hesitant up here without getting some shorter short-term oversold conditions, like an hourly oversold trade, right? Very, very tough for me because the monthly right now is extremely overbought. The weekly as well, extremely overbought. So I need to be more diligent with my dip buying opportunities. Now moving into Bitcoin. Bitcoin with a tremendous day today. Now the day was almost over. Bitcoin at one point was up about 5% on the day, guys. Extremely bullish candle from Bitcoin. And, right, daily downtrend was confirmed. They stop hunted the 60K level, taking out a bunch of liquidity down here and now pretty much running the opposite direction with it. You see this in Forex markets all the time. Classic market maker activities yesterday off of no news whatsoever, just pushing the boundaries as much as they can, sweeping all the limit order stop losses, and now just running the other way. So not looking too bad. We've now officially protected the $60,000 level. Not looking too bad. So we knew we were in a daily downtrend. Bulls have a nice engulfing move right now, not fully engulfing, but looking good, right? It is a 78% retracement. So the bulls creating a lot of space to be able to reset into a possible daily uptrend. Now back above our area of support, 61.8 down about 60,000. So I'd like to see the bulls use this as support, form a base, and give us a brand new daily uptrend. Only then will you know that your weekly higher lows are set, and we are possibly looking for the first weekly uptrend in Bitcoin since it ended back here in the month of March. We have not had one, so this would be a big thing if we can crack above 66.5. Looking very good, guys. And I still do have a few, well, I obviously have my long-term Bitcoin and all the crypto that I have on chain, but in terms of swing trades, I'll let you know how I'm going to be swing trading this one over the foreseeable future here at the end of the video when we go through the portfolio. Now, moving into our big tech names, we're going to go through these quickly as well because not much has changed. Apple still stuck in a sideways range at this point, guys. Very tough to trade this one, right? Essentially what we're looking for some trade opportunities is we need to have a retest of 219 down to about 215. As of right now, no clear direction in price action. And even above us, we need a break of 232 to really get that trending momentum going once again for the bulls. I wouldn't say there's any red flags in either or direction. It's just we've been trapped, guys. Trapped on the weekly now for literally the past 2 months. So no confirmed uptrend as of yet. Triple tops, but also not flushing the lows, right? So I still do expect Apple to be able to maintain this tightening range. If we come back down, retest the 219 to 214, I'll possibly be looking to write some short puts, 210 down to about 205 as low as I can get. And then to the upside, well, very tough for me to take a breakout trade right here, guys, when we're so close to resistance. The risk reward is just not worth it. I'm more keen on waiting for one of my favorite patterns, the confirmation of the weekly uptrend, breakout, retest the all-time highs and run. That's just a structurally more correct way of trading in my humble opinion. But as of right now, Apple not displaying any major red flags, but this one does remain a hold for me, guys. The bulls control a longer term monthly. That is no questions asked, right? But the valuation of this company up here just has me holding my long-term shares. I'm not adding to them. I'm not selling them. I'm literally just holding this company. Moving on to AMD. Give me a brief moment. AMD up about 2.26%. Not that bad of a day at all for AMD, right? Really coming alive after yesterday's drop after their AI event where they showcased the product that's going to be running as a direct competitor to NVIDIA's H200s and new Blackwell series. So their new commercial grade chip reacting very beautifully from our zone of support. And that's what I was telling you guys to keep an eye out for, right? So hourly oversold conditions. Huge hourly bounce. The bulls now have it in them to reset this hourly trend. So we might have just found the daily higher lows. Beautiful daily uptrend in motion right now. We were always looking for those daily higher lows for the furtherance of the daily uptrend. The bulls reacting very nicely from this location, 162 down to about 155. We know this area has been a very, very hot area of price action for AMD. So I would not be surprised if the bulls continue to use this one as support. Now, in the event we fail the highs, roll over into daily downtrend, is it that big of a deal, guys? No. Look who controls the weekly. Beautiful weekly uptrend. Look at this weekly MACD. Crazy cross, right? After literally the past 6 months, 6 to 9 months, if you include January. Well, if you take from the MACD cross, it's only about 6 months at this point, but still. You guys get what I'm saying, right? The bullish momentum is now coming back in favor of the bulls. So if we lose the short-term timeframes on the daily, getting the rollover and test this area of support again, what are we looking for, guys? Looking for the weekly higher low for further trend continuation, higher low into this big area of support with all the confluence of the moving averages. I will be a buyer, guys, and I'll be looking to probably write some short puts at the lower end of this support area right there, and also maybe even some call options for the 2025 breakout. I'll remind you why the 2025 breakout is coming. You need to look no further than the EPS expansion coming over the next 4 quarters, the revenue expansion coming over the next 4 quarters. Look at the annual basis, guys. 2025 is the year of exponential expansion, even in EPS as well, because they're finally ramping the data center business with that competitive commercial grade GPU, the NVIDIA competitor, right? Now, moving on to Amazon. So Amazon also looking quite good today, 1.16% to the upside, and the bulls starting to challenge overhead resistance, 187 up to about 190, looking quite good. We had the daily downtrend in motion by the bears, fully engulfing move. So if we get rejected right here, the bulls have a lot of space, guys, to set up what? Set up the daily higher lows for the second attempt at the break of resistance. Obviously, there's another scenario where we just blast through this resistance as if it's not even there, come back into it as support and run. That would be the classic breakout retest trade. So looking very good on Amazon, guys. Either one of 2 scenarios. Set up the daily higher lows and break, or just break higher and then higher lows coming down into it as support. Daily MACD looking good for a cross right now. Why do we have a bullish lean? Well, look at the weekly, guys. Beautiful weekly higher lows are set. Looking for the weekly trend expansion, looking very, very, very healthy. Weekly MACD crossing. It's not pretty, but it is getting into a more bullish direction right now. And the pricing of the company is looking very, very favorable right now at 170. I mean, we did it at 170, but now it's literally about 10% higher at 188. So you can literally just add 10% on top of this peg, right? I'll do it in my head. It's about a 1.6, but you can see right here, 1.42 times 1.1, which is 10%, 1.56. 1.56 peg for Amazon, not too bad at all, guys. But in the event we start retesting and breaking down here, coming and retesting the 180s again, I'm going to go with more call options and probably even some leaps. Looking very good, all things considered right now. Moving on to Google. Google up a very healthy 0.82%, but the bulls have a lot of work to do. But the one pattern that I want you guys to recognize is this inverse head and shoulders possibility for Google. That would be a big one, guys, because this is a weekly pattern as well. Could be a very, very, very strong move up in the event that we actually get it. So Google right now looking very, very good, even though we are slightly below, right? So daily downtrend on Google right now. The bulls need to reset everything from scratch, need to get a, very decent size retracement. As of right now, the size of the retracement is not the best, only about 40%. Would like to see the bulls at least come up to the 618, which is 167. Even as high as 169 would be more than welcome. Give the bulls enough space, guys, to reset into a possible daily uptrend or just engulf as a whole, right? But one of these 2 scenarios is what I'm looking for right now. In the event, and obviously resistance overhead right there, guys, 172 to 182. In the event we roll over on Google, guys, keep an eye on the weekly. What are we looking for? We had the weekly downtrend. The bulls put in a 100% engulfing move on the weekly, looking for the weekly higher low for possible further trend continuation. And if we come down here, guys, this 50 EMA, 160 to 158, well, you guys know, usually in the context of bull markets, when Google taps the 50 EMA, it usually always represents a very, very decent buying opportunity. Sometimes it can go a little bit lower. This is the interest rate tantrum of 2018. Not going to cover that. But you can see in Google's history, when usually it touches the 50 weekly, usually a very decent buying opportunity. And I will be loading up more call options, leap call options, if we come down there. And right now I'm playing short puts, guys, around the 160 very, very aggressively because the valuation of this company right now is extremely cheap at 158, even though they're slightly higher right now. It's literally a 1.14, 1.2 peg. Cheapest of all the big tech names right now. Moving into Meta. So Meta also looking quite decent today, 1.05% to the upside, but Meta was never at any risk, right? Daily uptrend was clear as day. Tons of space for the pullback. We were looking for the daily higher low. Right now, I wouldn't say that the bulls have it back in the bag, right? They lost the hourly uptrend. I wouldn't say we have it back, right? This is just a upswing. Need the confirmation. So we can't say the daily higher lows are set just yet. So even if we pull back a bit further, guys, anything above this guy, 555, looking for a daily higher low for further trend continuation into the 600 psychological level of resistance. And if Meta rolls this over, guys, is it that big of a deal? Nope. Look at the weekly. Beautiful weekly uptrend. looking, if anything, if we roll over, looking for the weekly higher lows for further trend continuation. And this one is one of my favorite setups, guys. If we retest 545, 550, right? Breakout, retest, and possibly run. I will be sitting here probably with some call options in the event Meta comes back here. And the valuation up here, even at $600, guys, is a 1.4 peg. It is extremely, extremely cheap, even if it is at the all-time highs. So do not let the share price of a company dissuade you from buying. Always look at the internals. Moving into Microsoft. Microsoft looking not too bad as well, 0.12% to the upside, trying to find a local bottom. So we knew Microsoft's in this big, big, big daily downtrend, and now we need to reverse this, right? But we know that the size of the bounce from Microsoft was not the best, barely a 45% bounce. Now, that doesn't give the bulls the best odds at all of reversing this into a daily uptrend, but if the rest of the markets continue pushing all-time highs, Microsoft will most likely follow, right? So we're looking for the daily higher lows for the daily uptrend right now. They almost have it. We almost lost the hourly trend. Double bottom. Now the bulls need to give me an hourly uptrend shift so that we can get this daily uptrend in motion. Crack 420. Give me the confirmed daily uptrend. Then we can say your weekly higher lows are set and possibly looking for another weekly leg of expansion higher. Just keep in mind, overhead resistance right now, 424 up to about 434, has been resistance for a while for Microsoft in the past year. We'll see how they deal with it when they get there. And in the rare occurrence that Microsoft rolls over and tests the 405 down to about 390, guys, this is leap call territory for me. So keep our eyes posted on those. I already have some short-term plays on Microsoft that I've built here, but if we come down here, I'll be going quite heavy on this stock, publicly on the channel, of course. Moving into Netflix right now. Netflix retracing a little bit, 1.03%. Not too big of a deal though, guys. Beautiful daily uptrend in motion. Higher lows are set. Beautiful leg of expansion right now. So at this point, any pullback, guys, you know the drill, looking for a higher low. Anything above 697, looking for a daily higher low for further trend continuation. But we know not too much price action left before Thursday when they have their earnings right up here. So we'll keep our eyes posted. But I would not be surprised if Netflix just kind of stays muted amongst the price action that it's been having for the last couple of weeks, right? That being said, Netflix usually always moves about 6-7% after earnings. So right now, even if we would pull back from this area, 6-7%, it really puts us in line with this big area of support, which can be best viewed on the weekly, right? Beautiful weekly uptrend, and now we've created some space, even if earnings are bad, and we pull back. Well, the weekly higher lows are here, 662. We have this big area of support to fall back into, but I am expecting quite good earnings from Netflix. But we know, even sometimes when big tech has great earnings, like last season, we can still fall down. So I always keep that in my model expectations, right? Moving into NVIDIA right now. NVIDIA doing a whole lot of nothing today, but that's not a bad thing, guys. Controlling decent levels up here at the higher levels. So moving into a new daily uptrend, we are just eventually looking for the eventual pullback. If we do get a pullback, anything above 115, looking for the daily higher low for further trend continuation. And now a good thing, we're above the 130 down to about 126 area of congestion that the bulls have gotten caught up with a few times over the past, roughly the past 3-4 months, let's call it. So this one, another nice pattern for continuation. Breakout, retest, and possibly run. So there's a swing trade here if we retest the 130 to 126, looking very good. Weekly, confirmed new weekly uptrend. Now that has not been the case, guys, since we had this big weekly uptrend right here, right? So now, after struggling for the past 3-4 months, finally a new confirmed weekly uptrend. And look out, guys, the MACD on the weekly is crossing again, right? This one is so tough to keep NVIDIA back, guys. It's like, I said it yesterday, it's like trying to stop a freight train, right? So much retail interest, so much institutional interest, and with good reason, right? So not looking too bad. Beautiful monthly higher lows are set, looking for furtherance of the trend. So keep an eye out for that short-term swing trade. And if ever it comes undone, right, if we unravel daily downtrend and get weak here over the next couple of weeks, not a problem, guys. Anything above 103 for a weekly higher low, you know the drill, for further trend continuation. At that point, target 114, 119, 114 could be a likely area of weekly pullback before maybe further rise. November and December, bullish seasonality. Moving into Tesla. So Tesla down almost 9% for their cyber cab event, Robotaxi event. But to be honest with you guys, I actually really like the event. Now, I'll explain to you the problems that happen, right? So first off, the problem that everybody was having is that we didn't get too much substance. It was a very good event, guys. for a marketing and advertising purpose, right? Those two things they absolutely nailed. The event was really cool. It gave us a glimpse into what the future can hold for us in maybe the next 10, 15, 20 years. But I'm pretty sure in saying nobody's expecting either the Optimus robots, the actual full self-driving robotaxis, or anything like that much before the next at least 2-3 years worth of time, right? But it's really cool to have a glimpse into what we're possibly looking into for the future. That being said, we didn't get any substance for the numbers, nothing to contribute to revenue and EPS growth at least before the next 2 years, which is why it was viewed as somewhat of a sell the news event for the stock price, because it didn't have any material impact on the stock price. Any forecasts and modeling are too far out in the future to have any meaningful impacts right now. That being said, guys, I am very, very pleased as a long-term Tesla shareholder for holding the stock, right? Elon Musk says this on every single earnings call. If you do not believe in full self-driving, if you do not believe in robotics, you should not be an investor in the stock long term. It is not supposed to be viewed as a car company. They are wanting to solve a lot more than simply just delivering good cars at good prices, right? I think everybody understands that by now. So let's have a look at some of the Robotaxi event highlights, right? The product, I mean, designs and everything like that are very subjective. What you may find appealing, I may not, and vice versa. What I may find appealing, you guys may not. Fashion, designs, and everything like that, it is subjective to you. It's a personal thing, right? That being said, my personal opinion, I think that they look really, really cool, right? They have the whole futuristic vibe, especially the way the format of the wheels. They look very good. And I'm not going to play the entire event, guys, just going to play some clips from it. But I want you guys to see the exterior of the cars. They look very good, right? The back end looks very good, kind of like Cybertruck-esque, something like that. It doesn't really need a rear view mirror because nobody's driving, right? Nobody's in the front seats. Literally just 2 seats and a screen, no steering wheel whatsoever. And here they are all following each other, completely being, automated, right? Just actual robotaxis. And they look, I personally think that the designs are very, very well done. Now, that being said, that is for the actual robotaxi right there. They also showcase the robo van for multiple people, right? Because obviously we know that they're trying to get away from personal transportation, you driving your own vehicle as a whole, and also buses and everything like that, right? When you go across certain places in Asia, certain parts of China, certain parts of Japan, they have things like this already. But this is Tesla's version of it. And I personally find that the design of this too, it looks quite good, right? It's very modern. It's very stylish. Now, you may not agree. That's just how I view the matter. It looks very, very nice, kind of like a bullet train looks like in Japan, right? Very sleek, very modern design. So I was very happy to see this. Nobody was expecting this as a whole. Then, obviously, we had the Optimus robots. And the Optimus robots, one of the clear takeaways, in my opinion, guys, has to be the articulation, right? The way the joints move and everything like that, it looks very, very, very good, right? It looks very, very, very good. You know, you can say human-like characteristics. Obviously, it's not entirely human-like. It's not as fluid as we are with our movements, but the articulation is very good, right? It's not static. It's not like super static robot mode. It's very fluid. So I like what they've done. It requires a tremendous amount, guys, of computing power and AI technology to make stiff objects and articulations move like this, right? A lot of hydraulics, a lot of electronics involved in this. So very proud of the work that the Tesla team has been putting on for that matter. And I want to show you guys what Elon Musk is trying to do, right? The greater vision here for the robotaxis. And he was talking about parking lots and just the impact that they have, the concrete impact that they have around stadiums, around airports, downtown areas. There's a lot of parking lots. And what he was saying is that if everybody gets away from driving their own cars, and if we move to kind of autonomous driving to where your car is just picking you up and dropping you off and then just goes and circulates everywhere. The cars are never really parked, right? They're just always in circulation or coming back home to your personal residence, right? Well, you end up with big parking lot concrete areas to green spaces, right? Which is very good for the environment. So as you can see right here, the thought process of Elon goes a lot deeper, guys, than just manufacturing efficient cars at good prices, free cash flow, EPS, right? he's trying to do a better service for mankind as a whole. So you can say what you want as Elon, as a person. You can say what you want about his personality, his political views, stuff like that, right? But as you can see, what he's trying to do, all of his projects are for trying to do a service to humanity, right? Instead of going, like you saw what, all of these parking lots turn to green spaces. And it's very, very, very impressive. I'm pretty sure not a lot of people have put that amount of thought into it, right? But it's true. There's a lot of concrete spaces that we could possibly do away with this technology, right? And we could talk about Starlink. We can talk about his other companies, what he's doing with SpaceX and stuff like that. But in terms of the Robotaxi event, as I said, I really, as a Tesla long-term shareholder, and focus is on the long term, right? I too acknowledge that many of these things will not be or will not have a direct impact on the share price, at least for the next maybe 5, 10 plus years, right? And that's what I'm here for. I am here for the long-term robotics play, the long-term energy play, the long-term full self-driving play. But in the short term, it's true that yesterday did not give us any meaningful insights as to how these elements of business are going to impact bottom line net margins. He gave us the price for a Optimus robot, about $20,000, $30,000 once they're at scale, right? But that's years and years away. Same thing for Robotaxis, right? We didn't get a cost, we didn't get a Model 2. So that's why Tesla's share price is down 9%. Sell the news event because there's no material impact on future cash flows in the next 2 years, which is what Wall Street was wanting, right? But I like the event for the long-term positioning of the company. Now, moving into the technicals, guys, daily downtrend, and that's what we were anticipating, right? If we had the daily downtrend, we would come down, tap the 200 daily MA, this green line right here, and also, right, the big support area that we're in right now. So this is big support for Tesla, guys. We're coming down, very hard move on the weekly, though, giving back a lot of weekly momentum, but we know Tesla can pull off something good sometimes, right? Loss of all the weekly momentum, and they still found a way to get it back. That being said, 220 where we are now, down to about 192 is the huge area of support. I would not be opposed to writing some short puts, a very conservative manner, 198 and below. They have their earnings, of course, in 2 weeks' time, so that's another big catalyst for them. But if anything, guys, sell the news event, and I will be looking for any extended drawdowns on Tesla. If we get daily oversold, I will be looking to write some short puts, guys, closer to 190 as possible. So that's just my analysis on Tesla for now. Sucks that we lost all the momentum right here, but it is a good area for a big support zone if you're looking for the possibility of setting up from a few swing trades, right? Moving into Palantir. Palantir flat for the day, guys. Not much to say here, right? The bull's in full control. We know massive daily uptrend, daily higher lows are set, and now trend expansion. So anything pretty much above 38.77, looking for a daily higher low for possible further trend continuation. But I'd be mindful, guys, if we get too much of a pullback here and get the daily rollover, is it that big of a deal? No, just looking for weekly consolidation, right? Tremendous 5-6 weeks worth of rally for Palantir, but we're extended on a lot of time frames, right? So be mindful if we do get a pullback here, next big area of support is 39 to 38. That's the big one that came back from 2020 and 2021. So if we get a little bit of a pullback, gonna open up some swing trade opportunities, guys. I'd like to see, anything below in or around 38, 37 for a little bit of a pullback here. I would not be opposed to making some swing trades on Palantir. But for me right now, guys, I'm not buying up here. I have a lot of long-term shares I've acquired, about an $11, $11.50 average cost down there. I'm just holding. I'm not buying more up here. I'm not selling any shares. If anything, I just wrote covered calls against my position with a lot of time on them still because I'm happy with the gains, just looking to farm some premium, and I will be looking for a little bit of a pullback. But as of now, guys, the bulls are in full absolute control. So congratulations to all you Palantir shareholders out there. Now, in terms of the positions that we have remaining in the account, guys, well, happy to say, here is directly from the Discord. This is the weekly recap. Pause it if you want to. I'm not going to spend too much time here, but I showed you guys a portfolio update yesterday. This is just a recap of every single trade, either a wheel trade that was placed today, all of them winning, and then our directional trades, call debit spreads and things of that nature, all also winning as well. Tremendous week for myself, tremendous week for all of our Discord members too. So very happy with the way this week played out. In terms of my current holdings, which one I currently have, guys, well, the portfolio is fairly light heading into next week, even though you see a lot of positions, not many positions with a lot of size, not many wheel trades. I have almost full buying power, guys, for next week. So not much has changed in terms of the markup of the portfolio. You'll see right here, the BITX trade 2. This one ended worthless, right? BITX around 27 right now. We also have 100 shares of BITX at 27.09. I wrote some covered calls. Look at how juicy these covered calls are, guys. $1.22. That's literally 4.5% for one single week. I'll take that every single time. We still have the CrowdStrike shares, going to look to sell those at about 330. Not quite there yet. The Disney swing trades, all of the Google trades that we've been over many times before, but we still have the bull call debit spreads for November. We have the leap call right here, which is now covered leading into earnings. We're up a decent amount of profit on those covered calls. Just looking to farm some premium while Google consolidates sideways. We have the 160 short put with a lot of time on them. We're already up a decent amount on those, but should be good. If Google moves up, the premium should collapse out of the contract very quickly. Covered all this stuff yesterday, just doing a quick recap. Nothing else changed. The one thing that I added today, guys, is more Microsoft bull call debit spreads. The February's 435s versus the 440s, 5 contracts at 199 a pop, looking for the Microsoft expansion into 435, 440. I will average into this trade if ever we fall below 407, 405. I'll be putting more into there. We still have the Micron long terms. The Netflix still have one tiny little remaining contract left on that one. Going to keep it for earnings. This Nike was an earnings play from last week. It's worthless. I'm just holding it not to pay $1 in commission to close it. I know I'm cheap, but why would you close it, right? Just let it expire worthless. This one was worthless after earnings last week, so I've just been keeping it there. It'll disappear tomorrow. New holdings. This one is called away right now. The stock ending above 1350, so that was our assignment price. 1350, so we made it out with, I'll show you guys, I have it right here, called away 1350 sale, 1327 cost, 1.7 ROI in 2 weeks. Our minimum is 0.5% per week, guys, so well above the minimum ROI right here. Easy peasy wheel trade getting called away, so all the buying power recaptured in the portfolio next week. OXY, we got a beautiful roll off today on the 55 calls for next week. We got about 69 cents in net credit. So our assignment on OXY right now, if you guys are following, here is the updated values right now. So our average cost right now is 53.47 on OXY. OXY right now is trading right around 55 at the close, if I'm not mistaken. Right around there, 54.76. So we're up on this position, guys, right now. Just looking to farm as much premium out of it as possible. So we'll see how this one goes. The calls are doing well as well. Only have one contract left, but we have until March, and we're up a good amount of money so far. We closed one just last week, if you guys remember. And then all the hedges, right? Well, the square leap calls are doing fantastic right now, up a ton on those. SQQQ and TLTs, these are all hedges, right? I was explaining yesterday, normal for me to have a hedge, guys, because the recession narrative is still in play right now. So I do want to have some hedges, but I am expecting to lose on these hedges if there's no recession. That's why they're called hedges. That's why my entire portfolio is not short, right? So I always run every week, I run about $100,000 of exposure. And you'll see right here, amongst everything, I have about, let's just call it, $13,000, $14,000 in short-term hedging exposure, which is about, depending on which one of these positions are open or not in a given week, it's roughly about between 10 and 13% of the portfolio that is exposed. Now, most of that, guys, is TLT shares. I don't have any time constraints on these. So the SQQQs are calls, the TLTs are calls, they have time constraints, but the TLT shares do not. And I'm looking to recover on these. As a matter of fact, we were assigned these, and these are part of my assignment, tracker as well. You'll see that the assignment break-even price for TLT is 97.15. So even though we are down right now, we got assigned at 99. We were able to farm a bunch. They pay dividends as well every single month. So we'll just ride this one out, guys, until we're profitable again. Pretty sure we'll be able to make it out of all these TLT trades with a decent profit. The SQQQs, however, those might be lost forever, potentially, right? But I still want to keep the hedge alive in the event we have a bad earnings season, right? In the event that we get bad data through the month of November as well. So just to know that I am hedged. And then the Twilio and waste management contracts that we discussed yesterday, those are still open too. So that is the brief portfolio rundown, guys. And as per usual, if you want to have all of these trades that we smash, and I'll even go back in time if you think that this week is an anomaly, right? The red are losses, and the losses I always keep small. You guys know me, right? So all the check marks are green. The the targets right here are assignments, and we're pretty much out of all of our assignments except for OXY and TLT, right? So all the green ones are wins, right? Just go through these. This is the last 5 weeks worth of the Discord. As you can see, far more. Out of all these assignments, the only one we still have is OXY. Ally Financial, we closed it for a tiny loss. I explained that one back in the channel, right? As a whole, right, been performing fairly well. So if you want to have all these trades in real time, guys, all the live streams as well, every single Monday through Friday, all of my trade ideas as well, and all of our private content, and talk to me in the Discord. You guys know the drill. The link is down below. I don't want to make this into a sales pitch. I'm not guaranteeing further future performance is this going to be the same as past performance, but you guys know me. If you like my trading style and you want to learn more, well, obviously the link to the Discord is down below in the description. I am here to help you, whether you're a beginner, intermediate, or advanced level investor, guys. I always have something for you. And if you're not, guys, well, always feel free to click the link down or to click the like button. Really appreciate it for the growth of the channel. Also consider subscribing if you're new. Would love to see you again. We do these videos every Monday through Friday after the close. So hopefully see you back in one in the future. And lastly, guys, if you have any questions at all, always feel free to leave them down below in the comments. Anything you want me to look at a stock, technical analysis, an options trade, a macroeconomic analysis. If you want to have a discussion about recession, no recession, anything you guys want, leave it down below and I'll be happy to engage with you, usually in the first 24 hours. So take care, guys. Always a pleasure. I'll see you this weekend, tomorrow, subscriber request video, and Sunday, top 5 options play. So take care. See you soon and peace.